Good morning from New York State. This is Andrew Wilkinson coming to you live from New York State with Interactive Brokers. Welcome to today's webinar, which is co-sponsored by the CME Group in Singapore. And today's guest will be David Lowe of Xmodeus Trading Group PLT. And he's going to be talking about WTI crude oil, life in the 60s and beyond. And just a couple of pieces of housekeeping before we start the event, before I hand over the microphone to David. Today's event is being recorded and it will be available for anybody who registered, so look out for that email a couple of hours after the event ends. If you have questions throughout the session for David, please enter them into the chat panel, into the question panel rather, on the GoToWebinar panel, and he will get to them either throughout the session or at the end of the session. I also have on the line with me Rachel Wong, representing the CME Group. If you have questions for Rachel about CME Group's products, and specifically the energy products that David's going to talk about today, also please put them into the question panel and we'll get Rachel on the line to discuss them. Today's handouts is available from the handout expansion panel on the GoToWebinar panel. The PDF is there for a download. And at the end of the session, when you X out of the webinar, you'll be faced with a survey. If you could answer the survey, that would be just great. Just helps us provide feedback regarding future events and what our attendees trade and which markets they participate in. So without further ado, I am going to hand the microphone over to David Lowe of Xmodeus Trading Group in Singapore. David, are you there?
Andrew, thank you very much for that introduction. As David here, not from Singapore, but right in Kuala Lumpur, Malaysia, capital of Malaysia, Kuala Lumpur, but very near to Singapore, of course. And first and foremost, before we start, a big thank you to IBKR and also CME for hosting and sponsoring this event. Firstly, I need to put this up, which is the disclosures. Yes, this is one of those things that we need to do before we start the webinar. Okay. Quick read, this speed read this, yeah. Okay, so we've done with the disclosures. We're going to move on to, this is the title, WTI crude oil life in the 60s and beyond. So the question is the party ending for the oil bulls, or is this just getting started? Now, the WTI crude oil achieved the $60 mark on February the 16th, so almost a month ago, slightly above a month ago, and it's been there now trading about 64-ish, 64 and a half. So the question has been, a lot of people have been asking me, where is it going from here? Yeah, a lot of people were surprised that it could reach the 60s. It was a huge what do you call that, recovery from the lows. So where's it going to go? Can we see it in the 80s? Some experts have been talking about crude oil in the 80s. Some have even talked about life in the 100. So we will see. We will see with this program to see what are those possibilities, or is it has come to an end, or is the party has ended? So we will look at that in this session. So this is what we are going to cover. We will have a look at the overview of the key factors affecting crude oil. What are the drivers? What are the fundamental drivers? Do those factors still apply? We will have a look at the technical outlook for the current crude oil prices. What is the phase of the market momentum at this current moment? What is the market psychology? We will look at the short-term outlook of the technical outlook. We will also go in and look at what is possibility of the technicals signaling over the next couple of months, and even look at a longer-term multi-month view of the technical outlook. So with that, we will also see what are the potential price direction scenarios where it can be heading to, which are the price points to look out for. And after we look at that, how are we going to explore the opportunities, trading opportunities, knowing possible price directions? What shall we do with these opportunities? And we will look at the CME group crude oil contracts to see whether we can use those contracts to trade those opportunities. What tools are available? We'll talk about the futures contracts. We'll talk about the options contracts. We'll talk about combining the futures contracts with the option contracts to have some very interesting strategies going forward. So let's start. We have the disclaimer, so we shan't look at this again. So yes, this is the performance of crude oil year to date in 2021. So this is 10 days ago, March the 8th, snapshot of the performance. And you can see over all those futures contracts. This is in fact, all those popular futures contracts, including the commodities, the indices, the currencies and all that. And you can see right on top here, which I've circled, all the top performers year to date are in the energy sector. Of course, crude oil, WTI, at that time, 10 days ago, was up about 37.7%. So it was near the high. In fact, it reached a high of 67.98. So very close to $68 a barrel. And the rest of them, you can see crude oil, heating oil, gasoline, all of this top performing in terms of year-to-date price increases have been in the energy sector. So this is very, very interesting. Okay, and we will see where it came from. Of course, this is the chart. Over the last 1 year has been a very, very wild ride. Since April last year, for the first time, we've seen WTI actually going into negative price. So from year to date, is actually we've seen has gone above 37%. The high of near to $68 was achieved on 8th of March, and we came off actually a historic low of minus 40.32 at one time, intraday low in April. It was 40.32. It settled at 37. And from there, the WTI made a huge and very sharp recovery from the lows. And then it started to consolidate from June of last year until November last year in this range, which was the 33 to 43 range. A long consolidation, almost 6 months staying sideways, trying to gain strength and trying to look for directions. And then finally made a very decisive move in November. It nominated a low at 33.64, and from there, the base, it moved upwards, a very strong surge to 66 in 4 months, almost doubled the price in 4 months. And of course, we saw that high in 8th of March. So it looks like this April 2020 lows at 40.3 has formed a so-called sustainable long-term bottom. If you look at the long-term charts, it seemed to have formed a sustainable long-term bottom for WTI. So unlikely to see this type of action, these types of low in the near term or foreseeable future. Right. So this is what we have come from, a very big ascent from the depths of the abyss. Okay, and this has been the key drivers. We look at the key drivers the last couple of months, how the oil price, WTI, has come up, and the bullish factors, of course, the last couple of months has been the weather, especially in Texas, and also Russia being one of the big producers of oil as well. The cold weather has curtailed the supply to the market. So we've seen lack of supply, thereby pushing prices up. There is also, of course, in the last couple of weeks and couple of months, the perception that the vaccine rollout has buoyed a lot of optimism, and the potential for and hope for a global economic recovery that has been featuring in a lot of people's minds. So potentially in oil as well, the demand could come up with the recovery in the global economic sectors. Earlier this month, March the 4th, we had the OPEC Plus policy meeting, and they held output, and they decided to keep their cuts in place, so that maintained a very bullish stance on the market. And of course, you had a few incidences in the Middle East, some geopolitical tension still happening there. So all these are piling on to the bullish sentiment for the WTI. At the side, of course, with the commodity fund buying further propping up support for the WTI prices. Now, on the bearish front, of course, is whether this demand recovery is real. A lot of things are still uncertain at this stage. The vaccine elation may quickly dissipate, if the COVID-19 numbers still continue to surge. Because a lot of countries, the lockdowns are slowly easing out, so people are coming out. So there is still this risk that infections could go up. And also, the news of some of the vaccines, some of these vaccine fears, or of it not being effective and all that. So these are some of the bearish things affecting the markets. And of course, with the higher oil prices, it encourages the producers and the energy firms to come out and reopen the rigs, increase supply to the market, and that will dampen, as supply comes into the market, will dampen the prices. And in terms of the cold weather is unlikely to sustain for a long time as the warmer months approach. So these are the key drivers currently in place. So those of you who are trading and looking at the WTI, keep a lookout for all these factors currently affecting the market, and see whether these key drivers will continue to sustain over the next weeks and months. So we'll jump to the technical outlook. Okay, so after the 8th of March, 10 days ago, we had a correction coming off the 68 high. Currently, what we are studying here is, okay, the terminology I'll be using, wave 4, you see that W4 is wave 4. We will be using the Elliott wave map. For those who are familiar with the Elliott wave, which is a theory of looking at the various momentum and market psychology of the markets. So I'm using the Elliott wave to analyze this market to see where we are in terms of the phase, momentum, and the market psychology. So I will be referring to the various waves. Okay, for those who are familiar, fine. If for those who are not too familiar, I'll try to explain the various waves. So in terms of looking at the hourly charts, we are seeing what we are currently in is after the 68 high, the markets have come down, and basically the wave three over here, you can see nominated in terms of the Elliott wave theory. In any sort of a trend or impulsive trend upwards, there is this 5-wave structure. Okay, in any up wave there'll be a 5-wave structure, and then there will be a three-wave corrective wave downwards. So the start of the wave usually the first wave, followed by a retractive wave, corrective wave of 2, followed by a very aggressive wave 3, and then followed by this 4th wave. From the 68 downwards to this wave 4 zone, which I've colored in pink over here, or purple, depending on the color you see on your screen, which is the 63 and the 64 region. So this target has been achieved on the 10th of March, and you could see that markets rebounded from this zone. So currently, since it's rebounded for this wave 4, is currently in what we've called the wave 5, and wave 5 is the last wave upwards for this particular time frame, which is the hourly wave. So we are currently in the 5th wave. Okay, so the 5th wave is expected to take out the 68 high. This the wave 3 high. Theoretically, the fifth wave normally will exceed the wave 3. So currently, it's already corrected. It's on the up wave. So we are looking at currently in the wave 5. But there's still a bit of a selling over here. There's still a lot of uncertainty coming off the wave 4. So the traders or the players don't see yet the conviction, but once it takes out this particular high here, which is around the 66.4, then you may see the momentum carry on upwards. We will later go into live charts. This chart was 2 days ago. You will see the live charts and see what are the possibilities in the live chart. So looking at the short-term trend, the next couple of days, you expect the prices to move towards the upside. We move on to the daily chart. Okay, when it comes to the daily chart, we are in what we call the wave 3. Okay, and this wave 3 has actually started. The wave 2 is actually the start of the wave 3. So this started actually in the beginning of this year. So we already actually in the full swing when you talk about this bullish trend upwards. Of course, we had this great move in end of November after a long sideways move. We had this coming up from the base to a wave 1, okay, then followed by this very, very aggressive wave 2 to 3. Okay, so this wave over here, starting in 2021, beginning of this year, was this very, very strong wave 3. Okay, so the wave 3 has been there moving for already close to 3 months. Okay, so the target zone for the daily chart, this wave 3 is 72.5 to 74.83 US dollars per barrel. This is the price which is calculated for the wave 3 peak. Okay, that is the zone that the wave 3 is expected to land. There is a possibility of a very extended target of the wave 3 at 88.5. Okay, the possibility is more towards the 72 to 74, but there is a possibility that if the bullish trend continues very strongly, that the wave 3 could extend to 88.5. Okay, why is there this wave 3 marked for this particular this trend is because we're looking at the momentum. There's continual new highs on the momentum, and when the momentum continue to make new highs, this is an indication of the wave 3. This is the characteristic of wave 3 with ever increasing momentum, as you can see over here. Okay, so that is the daily chart. We move on to have a look at the very longer term chart. Okay, so this is where people are talking about the possibility of oil at 80 and oil above 100. So in terms of looking at the multi-week and multi-month Elliott wave chart, okay, there is this possibility that the map for prices going above 100 is a possibility. Okay, if you look here, the weekly wave structure, currently we are in wave 3 as well. Okay, so in terms of looking at when traders look at trading the opportunity, they like to trade trends which are very, very strong. And so a lot of traders actually always look forward to trading the wave 3. So it's very interesting to see that the daily chart is in the wave 3 formation, although it's at the end part of it, but also on the weekly chart is on wave 3. So this is a very powerful part of the momentum that traders actually look forward to trade. So it's actually a very good time to look at WTI, because this is the wave and this is where the trend is strongest. Right? So currently, if you look at this weekly wave structure, the wave 3 is in progress, and the target zone for wave 3 conservatively, because I didn't take the start of the wave 1 at the low of 40. I started a bit more conservatively at 10. So based on this chart, you can probably look at a target zone of $86 to $91.4 per barrel. If you're looking at this wave 3 target for the multi-week or multi-month outlook. So the peak of wave 3 could then actually be followed by a strong correction down to 54. Okay, so if we map the Elliott wave for the weekly, we possibility of 86 then followed by a strong correction down to 54. Okay, and after this correction, because this correction downwards will be the fourth wave correction, and then according to the Elliott wave theory, we will have the fifth wave after the fourth wave correction, and the fifth wave is expected to take out that 86 to 91 high. So when it takes that up, then the fifth wave is very possible to see it go up to challenge the highs above 100. Okay, so in terms of looking at the longer term Elliott wave charts, there is this possibility that we will see the WTI above 100. Okay, that's the story being told by the map of the Elliott wave on the longer time frame. So what shall we do with all these opportunities? Okay, later we will look at the live charts. Okay, so we will look at what are the trading opportunities available using the NYMEX WTI crude futures and options contracts. Okay, so in terms of trading the WTI, for those who are not trading this contract yet, of course the most followed contract on CME is the NYMEX WTI, which is the crude oil futures based on the West Texas Intermediate or light sweet crude oil stored and distributed in Cushing, Oklahoma. This is the global benchmark for futures contract of WTI, and a lot of traders, of course, in the commercials who are involved in the oil trade hedge against the oil price moves, and or the traders will speculate on whether the prices will rise and fall using the WTI. So in terms of looking at the WTI, it's a 1,000 barrel contract. Each contract on the WTI is 1,000 barrels with a minimum tick of 1 cent per barrel. So that's the smallest tick is 1 cent, equivalent to 10 US dollars. The product symbol for the WTI is CL, and it trades almost 24 hours. Basically, you are able to act on whatever developments happening in the world. When it impacts the crude oil, you can trade it almost 24 hours. The WTI futures trades over 1.35 million contracts daily in 2020. So it's a very, very active contract. There are options available as well, quarterly, monthly, and weekly options, and we will see some of those options contracts later. Okay, one interesting thing is over the last 10 years, the Asian hours WTI volume has surged, especially over the last 3 years. Before that, in January and those years in 2012 and 2013, we only had the 10% of the total daily volume traded in the Asian hours. But last year in 2020, that number has doubled to an average of 21% of the daily volume on WTI traded during the Asian hours. So there's a lot of activity, even as we talk now in the Asia Pacific time zone. It's very, very active. So a lot of traders are trading round the clock currently. Okay, let's look at the crude oil options contract. Okay, this is the popular contract, which is also based on the light sweet crude oil futures, because it is based on that. So the options contract is also 1,000 barrels. Okay, now trading the options contract, of course, affords you the ability to trade crude oil with less capital requirements. Okay, margins, the premiums that you pay are usually less expensive than the margins that you pay for the futures contracts. You can, of course, the calls and puts can be bought at premiums which are comparatively less costly, right? That's what we say about the futures margin compared is cheaper. Do note, however, of course, when you're buying options, if you it expires worthless, if at the end of the expiry, you will lose the full premium that you paid. Okay, but of course that's the maximum risk is limited to the cost of the premium. Now, the beauty of trading options is there are a lot of combinations of various calls and puts that you can use, and it gives you a lot of flexibility and strategy alternatives. Later, we will see how we can use the crude oil options in combination with futures to have a strategy which is has a reduced risk in terms of trading crude oil. So the crude oil options are actually very active as well. It trades an average of 162,000 contracts daily, very, very active for an options contract. And this is one of those crude oil options which are very popular in the exchange. So we also have the weekly crude oil options, which is a weekly Friday expiration. These are very, very short-term options. Okay, for those, these are normally used by the professional managers to manage their short-term volatility risks when they require very precise timing and very targeted specific market movements, especially when there are things like the OPEC meetings where there will be policy, possibility of policy changes which may affect the prices. So these are a favorite among those people who are on a very, very short term, looking at certain developments in the oil markets. Okay, very similar as well. It's based on the light sweet crude oil futures CL contract, so it's 1,000 barrels as well. Okay, so we'll look at some examples of how the futures and the options are traded in bullish and bearish markets. This over here is an example of a bullish scenario. Okay, the bullish scenario for WTI, you can buy the futures contract. So this example here supposes that April WTI is trading at $60 per barrel, and each CL futures contract covers 1,000. If you remember, it covers 1,000 barrels of crude oil for every contract. So if a futures trader enters a long position, he buys one contract of April WTI futures at $60 a barrel. These are the two scenarios, possible scenarios. Okay, one is a profitable situation where there's a gain. So if you do $62, you would have a $2 gain for every barrel of the WTI futures. And since the contract size for the WTI futures is 1,000 barrels, the trader would have a gain of $2 multiplied by 1,000 barrels, which give the trader a $2,000 gain for that WTI futures contract. Now, of course, not all the time when you buy, the markets will go for you. The scenario which April futures, WTI futures could drop to 58. So thereby there's a loss of $2 per barrel for this particular situation. And then for the trader who is holding the long futures position, will suffer a loss of $2 multiplied by 1,000 barrels. So that's a $2,000 loss. We go into a bullish market using options. How to trade a bullish market using options. So a options trader could actually buy a call option. LO is the code for the crude oil options. Suppose the situation is similar to what we saw just now, April WTI futures. Remember that the call option is based on the WTI futures. So if April WTI futures is trading at 60, and the at the money ATM April crude oil 60 strike calls is trading at $2. Okay, so here we have an example of paying the crude oil 60 at the money premium at $2. The April the futures margins for crude oil currently I think stands around $4,000 to $5,000 per contract. So you could see here if you buy an April crude oil 60 at the money call, it's $2, so it's $2,000 for the premium, okay, of buying this call option. So if you are a trader, you enter into a long call position, you buy a call position, one contract of WTI crude oil LO 60 calls at $2 a barrel. You still have an exposure of 1,000 barrels in crude oil, and you only have to pay this $2,000 as a premium for the call option. Okay. Similarly, there are two scenarios that could happen. Market goes up for you. For example, in scenario one, if April WTI futures rises to 65 on expiration, then you'll be in the money. So we're looking at assuming that this will expire. So we are taking it to expiration for easier calculation. So if at expiry, the WTI futures ends at 65, and then you bought a call option at 60. So basically you have the option and you are $5 in the money, right? So this $5 in the money, $5 multiplied by 1,000, you have a $5,000 profit. But since you paid 2,000 in terms of the premium, you net a gain of $3,000. Okay. Similarly, the prices could actually drop to 55. So prices could go down, and if the April WTI futures drops to 55 on expiration, then your option will be out of the money. Okay, you had the option to buy WTI at 60, but now it's $55. So obviously you won't exercise this because it's out of the money. And if it's out of the money during expiration, then you would suffer a loss of $2,000, which is the maximum loss for holding the option out of money until expiration, and that is your maximum loss. Okay, so slightly different from futures in terms of the expiration. So we look at a situation where we have a bearish market. Okay, so in terms of looking at the bearish scenario, there's two things you could do. Of course, you could short the WTI crude oil futures, and in this example, WTI April is trading at 60. We went short. We sold the CL futures contract, and if the April WTI futures were to drop to 58, then we would have a gain of $2 per barrel, which gives you a gain of $2,000 for this short position. Obviously, if the April WTI futures were to rise and go against our position, and if it rises to $62, then we will be $2 multiplied by 1,000 barrels, which is $2,000 loss. Right? So this is trading the bearish market. And you could use the options as well to trade a bearish market, in which case you would go in and you will buy a crude oil put option. Okay, in LO, for example, the same scenario, April WTI futures, it trades at 60, and you bought a at the money April crude oil 60 put option trading at 190. These prices were at that time when I was doing this presentation. This was the prices of the put option. So when you go and buy one long put option, you pay a premium of 190 multiplied by 1,000, which is a premium of 1,900. The put option will give you the right to sell the crude oil at $60, and you pay the price of 1,009 for this option. So in scenario one, if April WTI futures drops to 55, okay, of course, on expiration, you will be in the money because you have the right to sell at 60, and the prices are now at 55. You would have a $5 difference between your 60 and 55, so that's 5,000 times 1,000 barrels. Sorry, $5 times 1,000 barrels will give you 5,000. But you remember that you paid 1,009 for the option, so that nets you a gain of 3,001. Now, if WTI were to rise to 65 on expiration, then your option will be, of course, out of the money. And if it's out money, then you will suffer a loss of 1,009, which is the maximum loss of holding the option out of money until expiration. Okay, so these are the couple of scenarios where you can trade the futures and options for the bearish or bullish markets on the WTI. Now, there is another possibility of trading. Those are very directional trades. So you either have the view that the WTI is going upwards or downwards. Now, if you are if the WTI is not moving anywhere, so let's say, for example, if the WTI goes into a wave 4 consolidation. So wave 4 consolidation is a sideways market, so it's not really going very much to the extremes. What you could use is you can use the the options as well to trade these sideways markets. And the popular strategies for trading crude oil options in the sideways markets is the short straddle or the short strangle. Okay, the short straddle is basically selling both a crude oil option call and puts with the same strike price and expiration date, which will give you this type of graph. You can see over here, this is the short straddle. You will gain if the prices don't move across to the extremes. These are the two extremes where you will lose money, but if the markets are in between, you will gain from the premiums that you take by selling these options. And a short strangle as well is very similar. You sell both a call option above the current crude oil price, and you also short a put option below the current CL price, both at the same expiration dates. So these are similar, what do you call that, strategies for trading the sideways markets. The maximum gain is, of course, the amount of premium collected from selling the option combinations. But bear in mind that potential loss could be unlimited if the price of crude oil were to move above those two extremes. Okay, so this is an example of how you could use the options to trade a sideways market. Okay, so please check, of course, when you're in terms of selling options, do check with IBKR on your ability to write and sell naked options on your trading account. Okay, there may be some restriction or there may be some requirements for you to sell the option. So this is something that you like to check with IBKR. Now, the thing about trading the futures markets, especially if you're just trading pure naked positions, you are subjected to the volatility of the market. And as you can see in the crude oil markets, we saw charts in the beginning of this presentations that the crude oil markets could be very, very volatile, right? So especially if you trade the daily charts, you're subject to a lot of movement. So I'm proposing or suggesting a strategy here for your consideration is how you can reduce your risk and also maximize your trading opportunities using a combination of futures and options. Now, the trader's dilemma is this, okay? If you have been trading for quite some time, you will understand that trading, you need to put a protective stop loss strategy, okay? The protective stop loss strategy, of course, is to make sure that you don't have a catastrophic loss in case you're wrong in the market, is to protect your capital and, of course, to protect your trading strategy as well. But a lot of people and a lot of traders that I meet have this inability, what you call it, to put a protective stop. A lot of traders don't like to put protective stops, right? There's also the inability to pull the trigger after a drawdown. What does that mean? When you have this protective stop loss and you perhaps trade the shorter time frames, you'll find that because of the volatility, you do get stopped up pretty often. Okay, and traders, after a series of stops being taken out, they'll tend to have this very reluctant to go in to take a position because they get a feeling that you can't pull the trigger right after this multiple number of stops being taken out. So the other thing is also the inability to re-establish the same direction trade after being stopped out due to near-term volatility. Some traders have this issue of they are right on the direction, but because of the short-term volatility, which takes them out of the position, they are unable to re-establish the same position in the same direction. So those are the dilemmas that traders face. And the last one is, of course, if you have a very good trade setup, but you see that there is a huge chunk of risk that you have to take in terms of the size of protective stop loss, you may not be able to take that potentially good trade. So in order to solve this couple of issues that face the traders, you could use a combination of options and futures. All right, so let's see how we can do that. So the solution is to hedge your futures position with options. Okay, so this is the rationale. Basically the options can be combined with your futures position, and the rationale behind it is you can still put your protective stops And because your protective stop is often triggered by market noise and spikes, you want to have a mechanism that you can still sustain you in the market while taking this type of volatility. The other thing is, of course, if you are holding a longer term position, if you're trading the daily charts and you're taking your positions over perhaps some adverse news events, some OPEC meetings, some data, say during Wednesday, where the data comes out, or even over the weekend, where things may have a lot of things may change, geopolitical risk and things may happen. There will be big price gaps. And the solution to solving these price gaps, where your stops are taken out way above what you are planned, is to have this what do you call that, hedge position with options. And these are the benefits. You will have a very defined maximum loss and risk. You will basically have reduced your downside risk using the option, okay? And it gives the traders space and time to reassess their strategy. Okay, let's say, for example, the position that you put in, the market turns against you. With the protective stop of an option, you are able to have the time to reassess your strategy to see that whether your strategy still works, and if it still works, then you still have a position in the market. Okay, and the last one, of course, is the buying of the insurance to help you sleep better, especially over the weekend or when you expect big news events coming on. Right, so you don't know whether that big news events will be for you or against you, but with this strategy, you are buying the insurance that you are protected. Right, so let's see how this is implemented. Okay, hedging futures with options. So this is what you do. You will go long and short your futures according to your methodology or according to your market view and analysis. Okay, but after doing that, you will also purchase at the same time ATM or slightly in the money options in the opposite direction as an insurance to your futures position. So in example one, if you long futures, you have a bullish view, okay, of the market. Perhaps you are trading, you look at it and you're trading the wave tree, so you want to be long futures because it's an impulsive wave upwards. You want to protect it with a long put. So for example, if you go long 10 contracts of CL, April 60, you buy at the same time 10 contracts of the options April 60 put, let's say 190, to protect your position. Okay, of course, if you are short futures, then you will buy the long call to protect your position. So if you are short futures, then you will go short, say for example 10 contracts of the futures April at 60, and then simultaneously buy 10 contracts of the April call options to protect your position. Okay, so with this type of strategy, you'll be able to create a option-like returns where you have limited risk and or reduced risk, and then you will be able to maximize the move or the position that you have. Okay, so this is something for you to consider, the combinations of futures and options as a possible strategy to minimize or reduce the risk of trading the futures, right? So you can go in and explore these various options, and you can try it out. Okay, for those who are new in trying out this strategy, I think if you are on the IBKR platform, either the IBKR Lite or the IBKR Pro, you can simulate. I think there is a simulated trading. You can use the strategy and simulate it and to see how that works out for you. Okay, so that's one way to try out the strategy, is to use the simulated trading on the platform of IBKR, right? So now I would like to move on to some live charts. I'll take you to the live charts and see what's happening real time currently. Before we move on to questions, we'll have some time to take some questions later after looking at these live charts. So let me switch on to the live charts. Okay, let's see over here. Okay, so what you see here is a live chart of the crude oil futures contract. This is a daily chart. Okay, so we have spoken just now, and we've said that the current phase of the daily chart is the third wave. Okay, so now we have to look out for the third wave, we spoke about the third wave target being at the 72 or the 74 level. So currently it's consolidating a bit. Later we'll go into the hourly chart and have a look at this consolidation in a bit more detail. Okay, so in terms of looking at this particular chart, so there's still a possibility after it reaches to the 72 high, then it will come down for a consolidation. So in terms of looking for the corrective wave 4 on the daily chart, there is a possibility after hitting that 72 high or 74 high, if it goes there, then you will have a consolidation corrective wave downwards. So we have moved you to the hourly chart. Let's have a look at the hourly chart and see what's going on here. Okay, so we see here after it reached the top at 67.98, it's come down to this zone here. This is where the corrective wave is supposed to end. Okay, so it's come down here and it's moved up, but it's still consolidating. Okay, so this is the particular price point you want to look at, which is the this is the high of 66.4. So it needs to take out this high of 66.4 to carry on to move up. Okay, in terms of looking at this particular wave, so now we are saying that the hourly chart, we're looking for wave 5 move. The wave 5 move will exceed the 68. And looking at the calculations of this hourly chart, you can expect the fifth wave of the hourly chart to land between 68 and 72, which actually coincide with the third wave calculated target for the daily chart. Okay, so 72 is where we are looking for this particular move to move up to. Now, if you're trading this particular chart formation now, with the prices trading at 63 to 64 level, we are very close to this low that was made in 10th of March, which is the low of 63.13. So let's say, for example, 63. This could be a good area if you feel that this fifth wave is going to continue. This may be a good area to look for a position, because if it turns and go below, breaks this fourth wave low, then things may not look too good, or the corrective waves will move deeper. So this particular area is a good area to look for positions if you're looking for a position of less risk, because you're looking at the picture turning if it moves below the 63. So this area where traders may want to have a look at whether they want to be in position for the fifth wave at this particular juncture. So that is a look at the hourly chart. So daily charts, we've seen it. So let's quickly just look at the weekly charts we spoke about just now. Of course, there will be no changes. So these are the projected areas. But bear in mind that these are multi-week and multi-month. Okay, so this particular chart doesn't show the time factor. So this, like, although I've drawn this wave, doesn't mean that it will happen in the next 6 months. These are likely to be very long term, but there is a possibility, as we said just now, this currently is on the third wave. Okay, once it's on the third wave, and this particular formation is possibility of seeing it at the 86 to 91 area, whereby after that will be followed by a corrective wave down to about 54 to 62 levels, then follow up by that last wave 5 upwards, which will take out this particular high at 86 or 91, and then see possibly go and challenge all the multiple highs over here. These are the highs you can see. These are long-term chart, 2012, 2013, and 2014. This is where the prices are above 100. So there's a possibility that if this particular low we said is going to be well supported, and if we're not going to see this low for a long time to come, then there's possibility that this particular chart will see all prices possibility at the 100 levels. Okay, so these are looking at the charts currently. So let me go back to the slides. Okay, we have some time now for Q&A. Let's see what we have over here. Questions. Let's see what we have got for the questions. Okay, I have a question over here. The question is, what time frame? This from Sam. What time frame do you use for trading? Okay, my favorite time frame is actually the 15 minutes and the 60 minutes charts. Basically, when I trade WTI crude oil, I'm a day trader for the crude oil, because I find that there's enough movement on the day-to-day basis for me to make it profitable to trade. So my personal trading time frame is 15 minutes. Or the daily chart. I trade most times daily charts. So I could hold positions overnight as well. I could hold it to the next day, but most of the time I would be in the market and out by the same day. So those are the chart formations that I use to trade the WTI. So those are my favorite time frames, the 15-minute and the 60-minute charts. For those of you who trade the longer term charts, if you're trading the daily charts, okay, you could actually use, because when you trade that, why do I pick the daily chart, the hourly and the 15-minute charts as compared to the daily charts? Because in terms of my setups for trading WTI, I find that the daily charts I would have to take. I would have that dilemma of taking very big protective stops, right? So that doesn't jive with my strategy. But you could try using, if you are trading the daily charts and if you are a position trader, then the strategy we spoke about using options to hedge your position in case of the volatility or the extreme volatility coming in, that could be a very, very good idea to implement if you are trading the daily charts. But personally, I trade the 15 minutes and the hourly charts to reduce the amount of the dollar risk that I'll take on my setups. Okay, so I would recommend those who are trading the daily charts and positions to have a look at that strategy of combining the futures with options. Okay, I have another question over here. Is any other indicators do you use apart from the Elliott wave? Okay, actually, when I'm trading okay, let me go back to the chart so that you can see what I use. Some also may be interested to know what sort of indicators I use. Okay, let me show you firstly my favorite charts. Okay, so this is an hourly chart, okay, and okay, if you can see, I basically have two types of indicators on this chart. I have this squiggly lines, okay, these three lines. This is what I use is the Bill Williams Alligator, okay, the Bill Williams Alligator. This Bill Williams Alligator, these three lines. They are basically moving average lines, and I use the Bill Williams Alligator as a filter. Okay, I will normally use the fractals, which let's see whether I can display some fractals for you. Okay, this will make the chart a bit easier, but let me remove all these drawings. Okay, remove this drawing first. Okay, you see the arrows here. I basically trade the higher high, higher lows trigger, but I use the what do you call that? The alligator to filter my trades. Okay, how do you use the alligator? Basically, any price above the alligator will indicate the trend. Okay, so for example, of course, very obvious over here in early of March. You can see that the prices are all trading above these three lines. This is where you want to be long. You want to hold a long position. Okay, and when it comes back to the alligator, if it comes back and trades in between these three lines, then it's an indication to take some profit because the markets are going into a corrective phase, right? So when I'm trading the Alligator, I will go long when prices are above the tree lines and go short if it's below the tree lines. Then I also use this AO. Okay, AO is also a Bill Williams. Bill Williams is one of those. Some of you may know his name, but he's one of those. This is my teacher as well, Bill Williams. I've learned his method for the last 20 years. Check him out. Bill Williams. He wrote this book called Trading Chaos, a very famous book for traders. You could check him out. And he also uses. He is the one that invented this indicator called the Awesome Oscillator, which I use to count the Elliott wave. This is the Awesome Oscillator. Okay, so if the momentum is above zero, of course, it's bullish, right? And if momentum is below zero, the prices tend to move down. Okay, so I use a combination of these two for trading on the hourly and the 15-minute chart. So those are the indicators that I use. Are there other indicators you can use? Of course, you can use depending on what are your favorite indicators, but these are what I use personally. Okay, and these are the fractals which I combine. So these are all Bill Williams methods, which is my favorite method to use for trading. Okay, let's see any other question. Also on the question of the Elliott wave, I use Elliott wave to basically to analyze, although I don't use it in terms of setups of entries and exits. I would use the Elliott wave as an indicator of which phase the market is. Let's say, for example, I know that now the hourly charts is trading on the fifth wave. Okay, so my position when I'm trading, I'm more disposed to incline to trading on the upside. So I'll look for buy signals or buy setups using the Alligator or the AO to trade. So I will use the Elliott wave to trade the phase, because in terms of the Elliott wave, the favorite wave to trade is the third wave, okay, which is the most aggressive trend and it's the strongest trend, and also the fifth wave, which is also the trend. Okay, so traders will try to avoid to trade the corrective wave, the second wave, and fourth wave, because it's very difficult to trade those waves. Okay, and the second and you can see over here on the fourth wave, it's very choppy, so it's kind of difficult to trade the second wave and the fourth wave. You want to trade the most aggressive wave, the third wave, and the fifth wave. And of course, there's also what we call a corrective C wave that we want to trade. So in terms of the Elliott wave, those are the waves that we want to trade. But I don't use it as a setup or a buy-sell signal per se, but to tell me which phase of the market is best to optimally put my positions. So is there any other questions?
So David,
yes.
Which fundamental data do you rely upon most for kind of that you believe is most likely to drive the market these days? I mean, the various reports come out Tuesday, Wednesday. What are the real fundamental drivers these days?
So of course, when you look at fundamental drivers, we had a few of those that we're looking. We are basically looking, I think, how the demand picture is coming on. Okay, because what we are seeing currently is we had this contraction in supply with push prices upwards because there's a squeeze in supply. But this supply situation with all the weather improving and what do you call that, the new rigs coming on, supply coming on. So this will be sort of increase the supply picture in the market. Now, if this supply comes in and the demand doesn't kick in, then we would have, of course, the situation will become rather bearish, because now we have supply moving on and the demand is not taking up, because the higher prices was in the anticipation of the demand coming in, right? So you would have to look at these two things. Of course, the demand is something which is very uncertain at this current moment, and this is one of the factors that I want to really look at. How is the situation on the demand side? Okay, whether the global economy is recovering fast enough. So that's one thing that I'll be looking closely for.
David, thank you very much.
Yep.
That was a very thorough explanation of trading the crude oil markets. I'd like to thank the audience for showing up, and I'd like to thank you, David, for taking time out of your evening over in Kuala Lumpur. A very interesting discussion. Thank you very much. And
thank you.
To Rachel Wong from the CME group for coming along. I've got no additional questions coming in for either the CME or for David from Xmodeus Trading. But thank you. Don't forget, everybody, the handout is available in the GoToWebinar panel. There will be a recording of today's session, and we'll probably post that to the Interactive Brokers YouTube channel later today, so check that out as well. And we look forward to having David come back to us. David, if you'd like to sign off, thank you very much for showing up. I really appreciate it. And once again, thank you for a great presentation. Over to you to wrap up, David.
Thank you. So it's good luck to everybody in their trading. I hope that this session has been helpful to all of you. So thank you, IBKR, and thank you, CME, for this hosting and sponsoring this event. See you guys soon.